Hello, and welcome back to our second video lecture dealing with Chapter 10, talking about accounting for liabilities. In the previous video, we looked at current liabilities, and we said that current liabilities are obligations that will come due within the year or the operating cycle, whichever's longer. And we looked at a number of current liabilities. We looked at our accounts payable, we looked at our notes payable, and we looked at our taxes payable by looking at how payroll is calculated. We also looked at unearned revenue. So in this video, we're going to look at long-term liabilities. So what exactly then is a long-term liability? Well, if a current liability is going to come due within the year of the operating cycle, whichever's longer, a long-term liability will not come due within the year or the operating cycle, whichever's longer. So these long-term liabilities are due way past the year. Could be due 5 years from now, 10 years from now, maybe even 2 years from now. Okay. Specifically, we're going to look at bonds payable. So what is a bond? A bond is a long-term debt instrument, right? Meaning a company issues bonds to raise cash, okay? And within the bond, basically what happens is the company says, investor, give me money. I promise I will make you periodic interest payments over the life of this bond, and once the bond matures, I will give you back your principal amount. So if we give a company $10,000, we invest in their bond, or we buy a bond from them rather, they're going to pay us periodic interest payments, usually semi-annually, maybe even quarterly, it all depends, for, let's say it's a 10-year bond, right? So over the next 10 years, we are going to get a number of interest payments. Once the 10 years is up, guess what? The company is then going to give us our principal $10,000 back to us. Okay, so there's a number of type of bonds that we have. We have zero coupon bonds. Zero coupon bonds really do not pay any periodic interest. However, we get the face amount back at maturity, and these bonds are sold at a large discount. What do you mean by that? Well, think of T-bills. If you're familiar with T-bills, let's say we'll buy a $25 T-bill, but I don't know, maybe 10 years from now, that $25 T-bill will be worth $100. Okay? So that's what we mean when we say they don't pay periodic interest. We just get a huge discount on buying that bond. Convertible bonds, these are bonds that are sold to bondholders, and the bondholder has the right to convert those bonds into common stock. Okay? There is a specified conversion rate. The next type of bond is a serial bond. Serial bonds just mature over a series of years. Okay. Debenture bonds. When we're looking at debenture bonds, basically the bonds are not backed by any asset or anything as collateral. Okay. Think about it this way. Think about a mortgage, right? If you take out a mortgage, that mortgage is secured by the house. If you default on that loan, guess what? The bank gets the house, okay? Same thing with companies. They do the same thing. Maybe they'll pledge an asset, or they'll pledge a building or whatever as collateral. So if something happens and the company can't pay us, they can then sell that asset to pay us our money back, okay? Debenture bonds, that just relies on the credit worthiness of the borrower, okay? So you get a credit card. They give you a credit limit. Is that based on anything? That's based on your credit worthiness, right? Is it backed by something? If you default on a credit card, are they going to come, let's say you buy a TV with a credit card and you default on the credit card. Are they going to come collect that TV? No, right? So there's nothing really backing that debenture bonds. Again, secured bonds, those have some specific piece of property pledged as collateral. So Bonds have a number of features, right? We have a call provision and we have a sink fund provision, right? What are these? Well, a call provision really allows the issuer, would be the company, to redeem that bond prior to the maturity date. Okay, so let's say that we have a 25-year bond and it's going to retire 25 years from now. Well, maybe we have a call provision that says within the first 20 years we cannot call that bond, but starting in year 20, if we decide, we can call that bond. And that means that we're saying we're not paying you any more interest. I'm calling your bond. Here's your principal money back. Okay? A sinking fund provision is something that is required of the borrower. So this is required of the company, right? And it requires them to retire a portion of the outstanding bonds each year. Okay? Similar to a sinking fund is similar to a serial bond. However, the serial bonds are designed to come due every year, every so many years. A sinking fund is actually a provision that says, hey, borrower, you need to retire a portion of the outstanding bonds each year. Okay, so they're two totally different things. Behave similarly, but they're different. Okay, so we're going to look at bonds, right? So we got to get this bond vocabulary in our under our belt. So the first thing that, or the first word that comes to mind when you start talking about bonds is going to be the face amount, right? What's the face amount? That face amount, or the face amount, is the amount that will be paid to the bondholder when that bond matures. Okay, so if I buy a bond, it's going to say $1,000 face value. That means that whenever this bond matures, this company is going to give me $1,000. Okay, the coupon rate. The coupon rate is the amount of periodic interest that's paid on that bond. So it will have a coupon rate or a stated rate. Let's say it's 6%. That means that over the year, the coupon rate, the periodic interest payments that are going to be paid to me or you as the bondholder are stated on that bond, and we're going to get 6% every year. Okay, the market rate. This is something totally different. The market rate is represents what the market will pay for bonds of similar risk and of similar length. So what we're saying here is we issue a bond, okay? There's a coupon rate and a market rate, right? The market rate has to deal with what are investors willing to pay, right? What return do they require, okay? So the market rate is nothing more than what the market will pay for a bond that's very similar to the one we're issuing, meaning it's similar in risk, it's similar in the length of time to maturity. Okay? So bonds can sell at different amounts, right? Well, what do we mean by that? Well, what we have to look at is, what is the coupon rate of the bond? Meaning, how much does a company state they're going to pay us? Well, we're going to pay you 8%. Okay, great. We need to look at what is the current interest rate in the market. Okay? The market interest rate changes all the time, right? So let's say that the coupon rate is equal to the market interest rate. They're both 8%. Right? That means that the bond will sell at its face value. If it has a face value of $1,000, people are willing to pay $1,000 for this bond. Okay? What happens if the market interest rate rises? Okay? If the market interest rate rises, the company is paying us 8% if we invest in them. However, based on the market interest rate of 10%, I can find another bond that is very similar to the 8% bond. It's similar in risk, similar in time to maturity. I could get 10%. So the company realizes this. Company says, okay, in order to entice somebody to buy my bond, which has a lower interest rate of 8%, I need to sell my bond at a discount, meaning instead of them paying $1,000, maybe they'll pay $940 for my bond, okay? So they'll pay $940 for my bond. I will pay them 8% interest based on the face amount of $1,000. Once that bond matures, I give them the face amount back of $1,000. Okay? What if the bond or the market interest rate conversely declines? My bond says I'll pay you 8%. However, other bonds of similar risk, of similar maturity, are issued at 6%. Okay? Based on that market rate, 6%. Well, let's think about this. Which bond would you rather have? The one paying 8% or the one paying 6%? You want the one paying 8%, right? You as an investor are willing to pay a premium to get that higher coupon rate. So instead of getting 8% on $1,000, instead of getting 6% on $1,000 bond, you go with this other company and you get 8% on $1,000 bond, okay? You're willing to pay more for that higher interest payment. Let's say you're willing to pay $1,050, okay? So you paid $1,050, right? Over the life of the bond, you're getting 8% based on that face amount of $1,000. When the bond matures, the company will give you the face amount $1,000, okay? So let's look. How do we record a bond? Super simple to do, right? Let's say we issue it at face amount. Super easy. Debit cash, credit bonds payable for the $1,000. No problem. What if we issue a bond at a discount? Well, okay. We have a bonds payable of $1,000, right? Because that's the face amount on the bond. So I owe somebody $1,000 when this bond matures. How much cash am I getting? Well, because I'm selling it at a discount, I'm getting less than $1,000. In this case, we'll say we're getting $970 cash. Debits and credits don't equal. We need to get those to equal. And in order to get those to equal, we use our discount on bonds payable account. Okay? It's going to be a contra liability account, right? Discount on bonds payable, $30. Now our journal entry balances. Same thing. What if I record issuance of the bond? However, I sell the bond at a premium. Okay, no problem. How much cash am I getting? Well, in this case, I'm getting $1,050. Okay, what's the bond payable? Bond payable is always going to be the face amount, which is $1,000. I have a $50 difference between my debits and credits. I need these to balance. So we use the premium on bonds payable account. Okay, $50. So we see now that our debits and credits all match. So whenever we're preparing our financial statements, right, we need to report the bonds payable less any discounts, or we need to report bonds payable plus any premiums that were on the bonds payable, okay? So bonds maturing in 1 year are going to appear, bonds maturing in over 1 year. Those will appear under the long-term liabilities on the balance sheet, okay? Again, any discounts, we have to reduce the bonds payable. Any premiums, we need to add to the liability. Okay. So what are some advantages of bonds? Why would a company want to issue bonds? Because, think about it. We're borrowing money. We got to not only repay that money back, but we also have to pay interest payments. So why would we want to do this? Well, number one, if we issue a bond, it does not affect our ownership interest, right? Meaning, we're not diluting our ownership, right? If we have 1,000 shares of stock, and say one person owns 1,000, or I'm sorry, 1,000 people own one stock, right? We have 1,000 owners. If we issue more stock, the ownership becomes diluted, right? Because I had one share, but now there's more shares being distributed, so my ownership in this company gets diluted. With bonds, that doesn't happen. Why? Because bondholders are creditors. They're not owners, right? So we keep our ownership intact as far as their the percentage of what they own in our business. Okay. The interest expense that we pay to our bondholders, that is tax deductible. Dividends are not tax deductible. So that's another benefit of being a bondholder, or issuing bonds rather. Okay. Another thing is that income to the common shareholders is going to increase or decrease depending on how well the company does, right? So let's say that the income to the common shareholders or the common stockholders, it could increase if we can earn more on the borrowed funds than what we pay for those borrowed funds, right? We call that leveraging. What the hell does that mean, right? All right, think about it this way. We're all owners of a company, okay? And the company obviously invests in their operations to generate income to pay us. The company identifies a project that could increase their revenue by 10%. Okay, great. But they need money to invest in this project. They could issue a bond to get the cash to buy the new equipment that they need and all the costs that they're going to incur to invest in this new project to generate revenue, right? So let's say they issue a bond and they're going to pay 5% interest on this bond, okay? Well, they take that and they invest in the project and they get a 10% return on their project, okay? Well, think about it. 5% of that return, that new project return, goes to the creditors because they need repaid for allowing us to borrow money. The difference, that 5%, goes to the shareholders. So a company could increase income to their shareholders if they leverage, if they borrow money. The key is whatever they invest in, whatever project they invest in, they have to get a higher return than what they owe to the bondholders. Okay? What are the disadvantages of bonds? Well, we have a contractual obligation with a bond. In the contract, we say we will pay you X percent of interest semi-annually. Our creditors don't care if our project doesn't pan out. They still want paid. They still have to be paid. Okay? That's number one. Number two, when we borrow funds, we have to repay them within a specific amount of time. Okay? That puts a big kink in our business plans, right? Because if we borrow $10,000 and let's say we have a 10-year bond, well, 10 years from now, guess what? We better have $10,000 to repay that loan, okay? If we issue stock, right, we get cash, we don't have to repay that stock, or we don't have to repay the cash that we received for that stock, okay? Another disadvantage of bonds is that bonds are going to implement, or they're going to have what we call a borrowing agreement, right? This borrowing agreement is going to restrict what the company can do, okay? We call these debt covenants, right? So what that means is if a company needs cash, okay, they have cash, they borrow money from issuing a bond, they have the cash. But the bondholders stipulate, you know what, you can't borrow any more money. or your debt to equity ratio has to be a certain percentage. And if it dips below that, we're going to have a problem. Okay? So we call those debt covenants. When we come back, we're going to look at contingent liabilities, and we're going to talk about how and when do we record contingent liabilities, and how and when do we disclose those contingent liabilities in the financial statements. Okay? I got to be honest, you will never ever, well, I don't want to say never ever. Did I ever tell you the story I was taking when I was at Chatham years ago at a tax class, and the professor says, Schedule F, it's farm income for doing taxes. Don't worry about it. You'll never see it. Then I get a job in accounting, and guess what the first 3 tax returns that came across my desk were? Schedule Fs, right? Farm income. So the point of that was, I can't say you'll never see this, right? What do you need to get through the class? I get it. As long as you know what the bond terminologies are, you're fine, okay? What the features of a bond are, you're fine. The types of bonds, you're fine. You will have to journal bonds, right, for the homework. I'm going to do a demo video and help you out with that, so we'll get more practice on that, okay? Advantages and disadvantages of bonds. If you know them, great. If not, that's okay, all right? But when we come back, we're going to talk about contingent liabilities. Contingent liabilities are actually kind of important, and we'll see what they are and exactly how they work. So please tune in for our next video where we talk about contingent liabilities.